Hi, everyone. It's great to be here. Very interesting presentations thus far. So a lot of my work involves looking at how markets and news interact. And, this, I guess, unfortunately, this latest crisis has provided a lot of important content for the kind of research that I do. And so this paper and sort of this research project has been an attempt to almost in real time monitor how markets and news interact and try to understand, what we can learn from markets about, the developing state of the world. So, oh, sorry, apologize about that. So here's an interesting chart that I'm sure some of you have seen, others of you may not have seen. It tells you what happened to the S&P 500 index, which is a broad stock market index that tracks the largest 500 companies in the US over the last few months. And superimposed on that chart is the incidence of COVID-19 case counts that you come from the Johns Hopkins disease tracker website and GitHub page. And the interesting thing to notice here is that, stock markets in the US and globally experienced extraordinary stress starting in February through, sometime towards the end of March. So the S&P 500 index fell by 34% from its February peak until its March trough. Along the way, experienced some of the most dramatic moves that markets had seen since the global financial crisis, but really even earlier since the Great Depression. So it was really an extraordinarily stressed time in our society, of course, but also in financial markets. At the same time, incidence of COVID-19 wasn't yet that pronounced. There was growth in some parts of the world. Obviously, people on this call know much more about this than I do, but just looking at a very blunt measure of what was going on, there wasn't, just in terms of absolute numbers, the incidence at this time in late February and early March was not that severe yet. Of course, it would turn severe later, but at the time it was not yet. So there's a question of, what caused this move, and a related question of what caused the move that we've seen in the last month or two, in the last 2 months since sort of 2/3 of the way into March. Like, how do we account for these two different regimes and markets? So this is a lot of what I've been trying to understand in work is if we look at contemporaneous explanations of market moves, like what do we find? Do we find that contemporaneous case counts drive market reaction? Do we find that contemporaneous news flow drives market reaction? Like, what exactly can we find that correlates with what markets do on a day-to-day basis? Of course, knowing that we can't explain everything that markets do, but at least can we find some of the salient features? So I guess there could be a few things that were affecting how market participants viewed the future. One was certainly a rational anticipation of what would happen. So there was an interesting article in the Wall Street Journal recently that the headline is "The Early Coronavirus Warning That Woke Up Wall Street." Apparently there was a call on January 31st with Jeremy Farrar, I'm hoping I get the name right, from the Wellcome Trust, that had investor types on it, and he spoke in very concerned terms about how the virus would progress. And so there was some speculation at the time that this could become very severe, and some market participants were already concerned quite early on, even weeks before that February sell-off that began to happen. There was, in addition to rational anticipation of what would happen, a lot of media speculation about tail scenarios. So when I have been a religious reader of news over the last several months, as I'm sure a lot of us have as well. And at least anecdotally, you know, there's a lot more negative ink, let's say, than positive ink. You know, it's not that anyone is doing anything nefarious, but the media tends to emphasize the downside risks of things. So there was certainly a lot of speculation around those kinds of things. To show some headlines, the Washington Post writes that you know, a market crash was coming even before the coronavirus. So the idea is that the world economic system was already so messed up post the global financial crisis of 08 and 09 that, you know, there's nothing unexpected here. Maybe the coronavirus is a catalyst, but this is something that would have happened anyway. The New York Times writes an article, maybe so less speculative perhaps, but kind of describing what's going on in very stark terms. Markets plunge, economies stall, panic spreads. It all feels very 2008. You know, so again, it's, you know, these kind of headlines, it's part fact, part editorializing a little bit by the journalist or the headline writer. And, you know, and then other headlines were even more severe. So, you know, here's one that says Trump's response to coronavirus pandemic may cause the next Great Depression. There is, by the way, a pervasive Great Depression narrative that usually surrounds any kind of financial crisis. And this crisis is different from other ones because it's had a tragic human toll. But there has been a pervasive Great Depression narrative around this crisis, and we begin to see it certainly around the time of the big market sell-off. So this kind of gives you the news flow that's out there, you know, in very anecdotal terms. That there's some stuff is, you know, experts speaking about how they think the disease could progress. Other stuff is, you know, maybe somewhat editorialized transcription of what's going on in markets, and other stuff is really highly speculative, and typically not speculative in the way that, you know, we think things will be okay, don't worry. Speculative in the way like, you know, we're looking at the Great Depression all over again. So that's kind of the news flow. So what's nice with regard to you know, those 4 articles is we actually now have the ability to analyze news flow like this in a very systematic way, both from the point of view of, you know, having computational resources to do this, having the open source software that does a lot of the text analytics, you know, effectively out of the box almost for free, and having very large data sets that allow us to monitor, you know, enormous amounts of news.
You have 2 minutes left, Harry.
I have 2 minutes left. Wow. Okay. All right. I guess I have to speed up.
We can take a little more time. You're the last speaker. So.
All right. Sorry. I guess I was anticipating. Okay. I should look at my clock more closely. So I look at 5 markets. I look at the S&P 500, this broad index of stocks, high yield bonds, the VIX index, which is, you can think of it as a forecast of future market volatility, like how much markets are going to wobble around, and 2- and 10-year treasuries. My news data set is all of the articles carried by the Reuters news service starting from January 17th, which was basically when they first started covering this, through April 30th, all articles that they carried that mentioned the terms coronavirus or COVID-19, and there are 72,000 such articles. I classify the articles into 12 topics, which, you know, I spent a little bit of time thinking how many topics, what's the right topic model, but this one seems by several criteria to fit the bill. And then ask the question, how do the news series that I get, so these 12 derived news series, how do they interact with markets and what can we learn from them? So I will, I'll go quickly. So the first thing that we notice is that if you ask the question of what forecast future case incidents, it turns out that the 5 markets, the reactions they had, line up fairly nicely with future case incidents at a lag of 2 to 4 weeks. So apparently financial markets, despite, you know, all the craziness and everything else that goes on, were very good forecasters of future case outcomes. Also, there's evidence that some of the news series themselves, so for example, the news series talking about central bank actions, about credit markets, interestingly about sports, several of the news series also are good forecasters of future future case outcomes. Several other series are not. So you sort of have this mixed bag of markets are pretty good forecasters of future case outcomes. Some of the new series are, some of the new series are not good forecasters. So with that, you can now ask the question of, well, what are the contemporaneous drivers of markets? So when you see markets sell off or go up on a given day, like what is the driver? So the first question here is, do news topics that are informative about future case incidents drive markets day to day? And the answer is yes, for some. Surprisingly, sports. Sports happens to be highly informative about the progression of case counts and also contemporaneously related to market activity for some reason. But the other news series that are informative about future case incidents actually are not that contemporaneously correlated with market moves. The news series that do drive markets, some of the topics are news about markets, health, Europe, aggregate sentiment, etc. There's many of them that are very contemporaneously related to what markets are doing. Unfortunately, a lot of these are not systematically related to future case incidents. So the market is reacting to news that doesn't seem to forecast the crucial thing that everyone out there wants to talk about. There's also evidence that when you look at what markets do yesterday and you ask the question, are today's news that are written deeply affected by what markets did yesterday? The answer to that question is yes. So basically, the picture that emerges is when markets do something very bad yesterday, the news that you see today is highly impacted by what markets did the day before. At the same time, I just showed you evidence that the news today is contemporaneously correlated with market action today, which then feeds into bad news tomorrow. And so you get this sort of negative feedback loop that precipitates. In the interest of time, I will skip the evidence, but there's also evidence on overreaction. So there's evidence that systematically what's been going on in this time is when you had a news item that caused markets to sell off on day T, that there's evidence that the same markets would rally in response to that news item on day T plus one, suggesting a lot of the contemporaneous reactions were somewhat overblown. And the other thing that happens is there's a structural break in all of this around mid-March, where all of the relationships, these lead-lag relationships from markets to news, the contemporaneous effect of these uninformative news series on markets, a lot of it just subsides. And mid-March is also around the time when the Federal Reserve Banks, and the board started taking extraordinary actions to address some of the market upheaval. And it seems that in the data, there's evidence that there is a regime shift that happens right around that middle to late March period. So to conclude, I speculate on these two things. I think the evidence is suggestive but not definitive. I think by repeatedly emphasizing potential negative outcomes, the media inadvertently contributes to market volatility. And furthermore, there's evidence that the Fed and its actions help break this negative markets news cycle. And part of the recovery that we're seeing is sort of this regime break that we saw in the news and markets relationship post the middle to late March. So I apologize, that was a little
no, it's okay.
at the end.
So a fascinating talk. I have a question. I guess it's kind of basic, and you probably addressed it, but are you saying that the news is a more powerful driver of the market than the actual pandemic?
On a day-to-day basis, there's very little evidence that any hard data about the pandemic drive markets. What seems to drive markets is in anticipation of the effect of the pandemic in the future. This is stuff that you don't get from the hard data. And this anticipation of what happens in the future is deeply affected by news coverage and by how the portrayal of market activity and the scientific advances. So markets are very forward-looking. There's evidence that markets properly anticipate what happens in the future, but day to day, there's very little evidence that actually the hard data about the virus and its progression is the thing that drives markets. It's all about the anticipation, and how that anticipation is formed is affected by thousands and thousands of different factors that influence people's perceptions.
So are there other markets internationally that have done better than in terms of not being so driven by news cycles?
So I think this is a good question. I mean, of the things that I've looked at, which is 5 particular asset classes in the US, they all seem to be driven by it. At a high frequency level, so on a daily level, they're very high. The correlations between the US and international markets have been extremely high. So like when you look in a given day, what happens in the US is the same thing that's happening in Germany and Japan, you know, and UK and China at different lags. Markets are open at different times. So what has happened is there have been clear winners and losers in financial markets as the dust has settled. Sort of that's kind of a lower frequency response. You know, some companies like the internet companies that have been, or the Amazons of the world that have been, and positive is a hard word to use here, but that have been affected, driven towards more business as a result of this, have seen, you know, record stock prices. Other businesses like Boeing and, you know, the cruise operators and the energy companies that have been deeply affected, those stocks remain at very depressed levels. So I think initially it's kind of everything moved all together, and then over the next several weeks to months, the market began to differentiate between the, you know, the very adversely impacted and the less adversely impacted companies. And now you see a very wide cross section of how things have reacted, where there have been clear losers on the corporate side, and then other ones that have been much less adversely impacted.
So we have time for a few short questions. Darcy, you want to ask a question?
Yeah, if you break down the market by sector, right, and go to biotech and pharma, I'm interested in the extent to which the science informs the way that portion of the market sector moves. We spent a lot of time on this symposium discussing potential, well, vaccines, which people don't make usually much money on, but certainly treatments, which they do. And I'm wondering about the relative impact of the scientific community versus the, you know, government pronouncements and the news media on the way in which that sector of the market advances or retreats.
So I don't have very, you know, a systematic analysis of the question that you're asking. I mean, anecdotally, we have seen in markets a lot of reaction, at least short-term reaction, to news about various drug trials and, you know, potential vaccine successes or failures. So, you know, like there will be a headline that some vaccine trial was very, you know, favorite, you know, look good, and then the next day there'll be a headline that, you know, some people are questioning those results, and markets will sell off. You know, one thing to say is that the pharmaceutical sector does not seem to have been particularly positively affected by all of this, like, nor adversely. Like, it's sort of been a middle of the road sector. The real beneficiaries, if you can call it that, have been the large technology companies. As I think a lot of the business, or I think a lot of us maybe have been surprised by how effective work from home has been. A lot of business people I talk to are deeply surprised by it, and a lot of people are questioning, you know, the old model of having this very expensive office space in Midtown Manhattan, whether it's needed. And so the pipes that are going to make that work, which is the Zooms of the world, and, you know, the Googles and the Amazons that do home delivery, like those companies have been, you know, very positive beneficiaries of all of this. I think that's been the sector that's been very positively affected. Anything having to do with leisure or travel or energy has been very negatively affected. I think the pharmaceutical has been kind of in the middle. And I think what you said rings true, that I don't think people think the pharma companies are going to make a lot of money in any of this stuff. And you know, stocks being cold, objective weighers of what will happen in the future don't see any kind of excessive profitability that will come from this for the pharmaceutical sector, with some exceptions. With, you know, if a small company is a particularly promising drug trial or vaccine under development, those are very positively affected. But for the large companies, much less so, is my feeling.
It looks like we have a question from Stuart Firestein. Stuart?
Hi, yeah, I was just curious about the effect of sports on the market, which seemed like a bit of an outlier. But then I thought of this article, which I'm sure you probably saw in the last day or so in the New York Times, that a lot of people who used to bet on sports and who can't do it anymore are now getting their, I suppose, dopamine rush, if you will, by betting in the market. Do you think that's having a serious effect on this, or a significant effect?
So I haven't seen that article. I doubt that, you know, financial markets are so large and so dominated by institutional players. I mean, I would find it very surprising that the transition of people away from gambling into stock market gambling is having first order effects. It probably is having some effects. I mean, I think more when you actually look at some of the headlines of the sports articles, they're very anticipatory of the progression of the virus. Like, it's a lot of speculation about when can we restart the soccer season? When can we stage tennis matches? When, you know, what's going to happen to the Tokyo Olympics? And it, you know, because there's no articles about sports being written that says, you know, the Yankees beat the Red Sox yesterday. It's all about, you know, how do you reopen stadiums with social distancing? When can the seasons restart? So it's actually a lot of the same kind of information written in very, you know, stark terms about, you know, when will the economy get to a place where we can have sports teams again? And I think that the same kind of considerations affect the overall impact of the coronavirus in society. And so my feeling is that that's why the sports topic is so important. It feels kind of odd, but then when you actually look at what they're discussing, it's not sports scores, it's all stuff about what could happen in the future.
And we have a question from Margaret Crosby Arnold. Margaret?
Hi, Harry. Thank you for that. So some politicians are, of course, experts at manipulating news cycles. So it strikes me that it's possible that the data, while not being a primary driver, is a secondary driver, and that you can manipulate what's in the news coverage by manipulating the data. So, for example, if it were reported that a person died of renal failure instead of COVID-19, that changes the data in terms of deaths due to COVID-19. And then if that is reported, so you can create a reality that you wish, and couldn't that lead to a sort of false optimism in the market if the data is sort of, you know, altered, if you will?
Yes, if the markets believe it. So if you know, like we all follow all the virus trackers. Like, if you look at incidents in places like Iran and Russia, like, and the deaths per million people statistics, like, I don't think anyone actually believes those numbers are real. So in a sense, some manipulation of the data is so egregious that people just see right through it. Whereas, you know, if there's subtle manipulation of the data, I think that's the most dangerous kind of thing for markets. Like, I think when markets really, and this was really a factor in the 2008-9 global financial crisis, there was a lack of confidence in that time the data that characterized corporate balance sheets. When there's a loss of confidence in the data, that's when all bets are off. The Fed can't fix it. Like, the restoring confidence in the system takes an enormous amount of effort. As of now, and this is really a stark difference between this crisis and the last one, there has not been a loss of confidence in either corporate America or the functioning of the system. So people by and large believe that corporate America is telling them the truth about their income and balance sheets, and people largely believe the data. If there was evidence that the data in the US is being manipulated by politicians, like things are being misreported as, you know, you're attributing deaths to things other than COVID when in fact it was COVID, I think that would precipitate an enormous market crisis, because there would be a lack of confidence in the underlying sort of infrastructure of the system. That has not happened. That was a much bigger factor in 2008-09. So I think that is clearly one of the big risks. I don't think that people believe that that is what's going on, but if it was going on, I think that would be very, very, very negative.
Thank you.
And we have a question from Ivalo Ivanov. Ivalo?
Yes. Hi, interesting talk. So I understand that the message was that the news is taking the markets, but I keep going to your first slide where you actually showed that after the initial big crash in January, February of the market, with the increase of COVID cases in the US, the markets actually improved. So I would imagine that with the increase of these cases, March, April, May, the news were getting more negative, but the markets were still gradually increased. So I'm wondering, how would you explain that? And I mean, two things I'm thinking is maybe the US news is not so, or the US cases are not so indicative of the markets, or maybe there are certain news channels that are more predictive for what happens with the market.
So those cases are global cases.
Okay.
So you can show in like a sort of in a stylized modeling framework that what drives stock price changes day to day are changes in people's beliefs about future cash flows and changes in the discount rates that people want to apply to those future cash flows. So if markets formed a belief about future case incidents that was much more severe than it turned out to be, then actually you can think of the market having a belief about the future case curve that's much more severe than what is actually realized, and then what is realized, while bad, is actually causing people to positively revise their beliefs about the future. So it's you know, markets are extraordinarily forward-looking. You know, they are discounting what happens, you know, 1 to 10 to 20 years ahead in some cases. And when you look at contemporaneous you know, case incidents, it's possible that while it's severe, it's coming in better than people think it should be, and so people are actually, even when it, you know, the absolute magnitude of the changes become very dramatic, is a time when people are positively revising their belief about the future progression because their belief was already much worse than, you know, than what we're seeing realized. And the second channel there is, you know, people at some point become very risk averse to owning stocks, and as that risk aversion subsides somewhat, then that second component kicks in, and people sort of revise the discount rates that they apply to future cash flows. And as you revise down the discount rates, then stock prices can appreciate again. So, you know, so economists can make up all sorts of reasons why things don't work in the intuitive way. And I think that, so that would be two explanations for why there could be this divergence from hard data with what markets are actually doing.